3, 2, 1. Hi, this is Jeffrey Cohen, Chicago Quantum. I'm here to give you week 13 on the markets and our quantum consulting firm. And so this week, it's a little different. This is Good Friday. Markets are closed. It's our chance to catch up and think a little bit deeper. And so I promise you later today we're going to be coding like crazy and trying to add some new features and capabilities to our system. But for today, it's time to talk about what the markets are doing and why, and what we're seeing. And it's interesting when you give us a couple of minutes to talk to you each week, how the story changes. Normally, it's Friday. We've been through a hectic week. We've been trading. We've been running jobs. We've been working with clients. And today we're relaxing. And so it's given us time to really think about the markets. And so I'm going to talk a little bit about things. And so we're going to start with the markets. We're going to start with economic data. And then at the end, we're going to talk about our firm. And so let's get started. I got all these pages up, so I'm going to walk you through them all. So the first one, and I realize a little hard to see there, is the U.S. economy has added 916,000 jobs in March. That's a big number. That's actually a very big number. And our unemployment rate, people who are looking for work, is down to 6%. In fact, what that tells me is we're starting to get back to normal in terms of our economic situation, at least in terms of labor and people who want to work. There's friends of mine that I know. In fact, one of them I just congratulated today on LinkedIn. You know, he's more what I would call a gray-haired individual, right? Somebody who's been around, and he just got picked up by Google. It's a great job, and there's jobs out there for people. The business world is picking up, and so I just say that's something. There's some good news out there. I'm going to walk right into the market. So we look at the S&P 500, and you see that first number is a 4,000. The S&P 500 is up to 4,000. Wasn't that long ago? It was 3,000. Right, May, and so it's gone up a third since May. So what's interesting, though, is it was less than 2,500 52 weeks ago. So from March 30 to May, it went up 500 points, 20%, and it went up another one-third. The rate of increase is slowing post-COVID pandemic recovery, but still pretty healthy. And what we're seeing here is that volume has been up a little bit, and as volume has come up, the market's not always doing so well. So it's an interesting time. That the market is reaching new highs, but I am reading The Great Crash of 1929 by John Kenneth Galbraith, which is standard reading for economic students. I believe I read the book in the 1980s, but from a friend, I'm reading it again. And so I'm looking for parallels in our market as well as in the past. And one of the things that John Kenneth Galbraith reminds us of is for the market to go down, it doesn't mean that the economic picture is going down. It means the future, past what we all normally can see, is negative. And so I'm going to look for those signs. In fact, there's another chart I realized I did not pull up, the yield curve, which I'll do that at the end. But if we take a look, right, the S&P looks strong. Looks great, actually, at 4,000. That's a big milestone that we passed. So if we keep going, let's look at the NASDAQ. The NASDAQ is up. In just past the COVID, it was 7,300. You look at around May, June, you were at almost 10,000. Now you're at 13,400. So pretty healthy, pretty healthy recovery. But you notice little flat now lately. Volumes have been pretty flat. Market's been pretty flat. And so maybe some of the impetus to the fast rise is gone. So maybe the market's slowing down a little bit, which is interesting. It's actually good to see that. Not so much if you're in the market fully invested, you want to see it going up every day. But trust me, there's plenty of shorts out there that are betting against it. And so it looks like the supply-demand curve is kind of flattening in the market. We look at the Russell. I mean, Russell looks great. Look at that. The thing was down around 1,000, 1,100, right? Post-COVID. Now, you look at it around, May, June, from 13, 1,400. So it's healthy. It's 50% up. And that's been a great rise. But again, take a look at that. Volume's declining, right? Since it was at 2,200. So this last little oomph has been on lower volumes. And so, I tend to trust prices and volume when they confirm each other. And so in this case, not sure, right? I see a strong Russell, I see weak volume. And so just something to think about. Let's look at crude. So I can just tell you at $61, it's been about where it has been for a while. And the challenge with crude is that you have a lot of foreign actors, right? So let's look at it for a year. Take a look at that chart. Booyah, right? 40s. And from 40s, 35, right? Came up to 60. And now at 60, things change in the economic picture, right? You start to drill more wells. And we've seen that in the Baker Hughes data, 13 new rigs. In fact, minus one on the natural gas, plus 13 overall. So we're seeing some strong rig count, which is great to see. In fact, I'll pull that up for you. I love the Baker Hughes data. Thank you guys for producing it every week. Tremendous asset for guys in oil and gas biz. So here it is. So for the U.S., 430 rigs. So they're not producing yet, but they're looking up 13. You're still down 234 from last year, but that number's been a lot worse. And if you look at Canada, again, I'm a broken record. 69 rigs for all of Canada. This is terrible. Bring back the Keystone. Bring it back. We need our friends in Canada. Make some money. By the way, we took a vacation last week. We went to the Cherokee Nation, the East Branch. It's pretty cool. They've got a Tale of Tears story, though, that I recommend that everyone take a moment, take a look at. Quarter of the population died. It was kind of like the Bataan Death March, except it was in the United States. And so, not a good story. Not a good story. If you've got Native American in your roots, this is sad. Or even if you're just anyone, something to think about. So, what I want to tell you is rigs are up. I'm very excited about this because it's good for business. So what else can I tell you? I can tell you that the Saudis have talked about moderating their production increases. OPEC Plus talked about being a little more moderate. And so what that says is we're probably still going to see good. Let's see if there's anything here in the news. OPEC Plus throws another curveball, right? They may loosen production restrictions, but maybe not so bad. And so, we'd like to see oil up so that we can have more jobs producing oil, making pipelines, and helping our economy. But on the other hand, it costs more than when you go to the pump. And so it's a double-edged sword. So what I say is just follow the numbers here. Let's take a look at gold. So what I've noticed is the dollar's changed, right? So you're going to see this pattern through the week, and you've actually seen it in other weeks, which is week starts strong. Look, gold, 1730, 1724, looks fine. Booyah, drop down, right? Tuesday, Wednesday, you're down to 1600s, 1680, 1670, 1690, and then end of the week, Thursday, it was a short week because of Good Friday, you're back up where you left off at 1730. I don't understand. So, the point is, markets are dipping midweek. I'm seeing a trend here. We're going to take a look at the dollar. You're going to see some changes there too. So let's take a look at the euro. Oh, look, same shape, right? $1.17, $1.17.2, $1.17.1 from a $1.17.8 or 9. So what you're seeing here is you're seeing a dollar strengthen midweek. I'm not sure what happened. I'm sure there was some news, but I worry about that. I worry about dollar strength, right? The U.S. Canadian dollar, right? You're going to see the dollar, and so cash is still king. By the way, cash has always been king. Strong dollar, right? And so I bet we're going to see an impact in the trade numbers, right? Because a strong dollar. So think of it this way: if I go to Europe and everything costs $1.17 a euro, I remember when it was $1.35. Now it hasn't been that for a while, but for the year, it's been $1.07 to $1.24. You know, at $1.17, I want to buy a pair of Italian leather shoes. I want to buy a cup of coffee. I want to buy some German trinkets, electronics, steel, anything, right? I want to import. Imports are cheaper. Exports more expensive because those euros don't buy as many dollars. I got to pay more, and so now, right, we want to buy more of their stuff. They want to buy less of ours. And when the dollar's stronger, it also changes the way that commodities, many commodities, gold, oil, others that are priced in U.S. dollars are priced. And so we see it in the euro. We see a dollar strengthening midweek. Let's see what else we see. Let's look at the Japanese yen. Now, what's interesting is the Japanese yen, it's the other way around. So 110, 109, 108, right? It's 109. So at 109 euro per dollar, and then 110 euro per dollar, so the dollar strengthened towards the end of the week. Stronger dollar with relation to the yen, and you see the 52-week range at at 102 yen to 110 yen. We're at the strong end of the range for the year. So again, strong dollar. So now when we work with Japan, right, Japan's going to sell us a lot of stuff, electronics and things like that, and we're not going to sell them as much. I bet we're going to see this in the trade numbers. By the way, maybe I should just show you the trade numbers because I pulled them up. We'll come back to it. We'll get there. So take a look at the Bitcoin. Now this is always interesting because it doesn't seem to reflect anything with the dollar strength or anything. It's something totally different. So euro is 55. Now it's almost 60. No idea. Look, Friday, right? Because today the market's closed. So looks pretty strong. So maybe this is just a non-U.S. economic phenomenon. And who knows, right? I don't know. So what I will say is it's up for the week. It's at 59.8, 59.9. It's high. It's its own phenomenon, the Bitcoin. So now we're going to look at Treasury yield curve. And actually, I'm going to pull that up. Again, I explained last week where to find it, right? You go to FINRA, bond search results. So FINRA Markets, Morningstar.com. Let's take a look at bonds. Let's take a look at the Treasury yield. So we look at the Treasury yield last close. Make sure it's big enough you could read the numbers this way, right? I want you to be able to read the numbers. Short-term yields are not zero, but they're about as close as you're going to get. 2 bips, 4 bips for 6 months, 17 basis points for 2 years. So, hey, I'm going to lend you money for 2 years, federal government. 2 years. I'll give you 17 basis points. I'll give you less than 0.2%. There's no way I'm lending the government money at that kind of rate. Right? If I want to even get 2% on my money, I got to give them the money for 30 years. So, But what's interesting when you look at the red is the current, right? Is it's an upward sloping yield curve. So what that says is, right now the economy, they don't know what to do with money. So they're happy. It's safe. Give it to the feds. Let them hang on to it. It's a sovereign issuer. There's no risk. They're the reserve currency. I got this. Okay. I got extra money in my pocket. Where's my wallet? I got extra money. Hey, Fed, why don't you take it? Right. Here's a couple 20s. I give it to you. At least you keep me safe. At least I don't. I'm okay there. Right. FDIC insurance is what, $250,000? This hooks me up. I'm safe. But 5 years, 10 years, 30 years, now we're starting to look at maybe I build a factory. Honestly, for me, I'm buying servers. I'm buying equipment. Maybe today is not great, but a year from now, 2 years from now, 5 years from now, I think the economy is going to do great. And so an upward sloping yield curve says that the business people of America, they see opportunity. That's positive for the economy. That's positive for the stock market. When we see a downward sloping yield curve, an inverted yield curve, that's bad, because that means I need safety later. I can't invest my money. So I love it. Steepen more. That's a good sign for the business that we're all in. So when I looked at some of the other exchanges, I can only do this for a day, but you can see the intraday high and lows. There were a couple that kind of struck me. So volatility, the VIX, it's at 17.3. So at a time when I've heard so much concern, when my friend is sending me the great crash of 1929, selling things. Oh, Jeff, it's terrible out there, right? The VIX is down. For the 52-week range, it's down. Fear is gone. Markets are going up. There's no fear. It's the lowest it's been in a year, right? Volatility, fear, volatility. We look at other markets right here, all these that I'm going to run on my cursor over: Nikkei, Russia, Belgium, Euro, the CAC, which is France, Germany, the UK, all at 52-week highs. New York Composite, 52-week high. Dow 30, 52. S&P 500, 52-week high. The NASDAQ came off a little, which is interesting, because normally those are the ones that drive ahead, right? The Apples, the Facebooks, Tesla, but maybe something's going on there. I look at China, and I see high, but not quite at the 52-week. So we know China came back. I talked about that 2 weeks ago. China's still off the highs. But again, then you look at things like the Aussies, Singapore. Actually, Aussies are at the high. Singapore's pretty high, and on and on. Toronto, or I should say Canada exchange is up pretty high. And, lots of mix here. So markets are healthy right now. Markets are very, very positive, very healthy. So we looked at the treasuries. Again, not a lot to see, right? Yields came up. Yields came down. The thing that struck me with the treasury yield curve, and I'm going to pop this up for you guys. I use the 10-year as a proxy because I want you to think about 10-year money. Okay, it's a good proxy for long money, right? And so we go back before COVID. Rates were high, 3.2, came down really in August of last year to below 2, and bounced up at a 2%, looks like a resistance line, and then crashed down right through COVID. And I think this was the monetary response, Federal Reserve response to a pandemic, which, thank you, ring the cowbell, Federal Reserve stepped in and helped us out. And the market responded. And the rates are come down. So I think I was afraid, right? You could see 2-3% money right away. I thought this was going to kill everything. This is going to destroy equities and commodities and just throw things into a tailspin. Seems to have moderated. You've got an up and down pattern here. It looks like it's forming a rectangle. Don't know where it's going to come. It actually could pop the other way. It could come back down. but you see a flattening. I don't know if that's a flag or if that's a rectangle, but regardless, it's a flattening situation. And so, yeah, 10-year Treasury, maybe all summer, we're going to see some rest in that thing. But I feel better, right? Because the momentum driver, right? When we look at 2021, this thing was 0.9. To go to 1 point, at one point, it was like 1.75. It just seemed crazy. And what didn't worry me was the absolute number, it was the trend. And so I think if we zoom in, I want to zoom in for you, you could see how the thing popped up for this year, right? And now it's an up and down pattern. So this could be positive. Let's take a look at the payrolls. I know we started with this 916,000 jobs, payroll jobs. This is amazing. Change in non-farm payrolls up. They expected 660, right? The unemployment rate is 6%. Hourly earnings month over month went down 0.1%. And it revised up 0.3 in February. So I want you to think about what that means for a minute. We're not paying the workers anymore. It's not an overheating of the market. Right, so workers are coming back to work, and they made actually a little less than they made a month before. But there's a lot more workers, and so the supply and demand, I guess, is still with the employers. But so this is not a pressure, inflationary pressure driving up wages. There's inflation on products, probably because of the dollar rising, and because of oil rising. And because of shocks in the system, and because of the Suez Canal and all that weird stuff. This is interesting. This is negative, right? Hourly earning rise. And the average hourly earnings year over year is up 4.2%. And so what's happening is year over year, the number's gone up. So people are earning 4.2% more than they did a year ago. So the inflationary pressure was more kind of over the past year, and revised plus 5.2 in February. So it's been good. We're seeing a recovery in wages. We like that, right? Because that's more money to spend. That says good things about the Main Street economy. This was just some more on currency. Not that interesting right now. So we're going to get into some underlying economic news that I thought was interesting to share. So the first, gross domestic product. So let's make sure you can see this. Let's zoom right in. Those numbers are hard to see. God, I love this number. U.S. net international investment position. U.S. residents' foreign financial assets. The difference between our foreign assets and liabilities was negative 14 trillion. And assets totaled 32, liabilities were 46. So we owe. We're an ower. We're a debtor nation. It's not good. Look at that number. It's coming way down. We owe. The United States owes. Other people, they borrow. They're lending to us. If we look at our gross domestic product for the third quarter of fourth quarter of 2020, it's at plus 4%, plus 4.3%. So our gross domestic product is healthy. That number, I would have loved to have seen that a few years ago. Personal income, though, was down. And I'm going to zoom in on what that is. Right, that's less money in your pocket to spend. International transactions, you see that's a negative. We're going to talk about that. And international trade in goods and services is down as well. And so, gross domestic product looks fine. Everything else is a negative. That's not helpful. Let's talk about it. U.S. international transactions. Current account. We are in a current account deficit. So we have our income, we have our primary income, we have goods and services, and we have secondary income. And the problem is that our goods we sell goods overseas more. I'm sorry, we sell services overseas more than they buy from us. Think of what would they buy from us? They might buy consulting services. They might buy investment banking services. They might buy data analytics services like what we provide, if it's kind of leading edge in the world, right? Research services. It's fine. But goods, taking a bath, look at that. Negative, I can't even read that number, it's so high. On a quarterly basis, it's over $200 billion. Then you see primary, secondary income, kind of a wash. So we're running a negative current account, and we've run a negative current account, and it has dive bombed from 100, looks like almost 175. Not helpful. Not helpful. So money is flowing out of the United States. Now let's take a look at personal income. Did great in January, up 10% from the preceding month, which was flat, which was down, and now in February you're down 7%. So personal income is down in February. Disposable income was up in January, it's down in February. Personal consumption expenditures down in February. So what this says is things are slowing down a little bit. Price indexes, though, are up. So we have less money to spend, and the price that we pay for things is going up. So this says that the average human in the United States does worse right now for personal income and outlays. This is the Bureau of Economic Analysis, U.S. government website. I'm going to save this one because we are going to be using this type of data later on. So when we talk about Main Street and Wall Street, right, this is Main Street. It's Main Street. I don't like it. I don't like it when we have less income and we have a current account deficit. So let's take a look at the Consumer Price Index. Come on, Jeff. There's no inflation. What are you talking about? 2%. That's what the Fed said. I want to see 2%. I haven't had 2% in a decade. Well, guess what? You're 1.7. The all urban consumers in February rose 0.4, and it's up 1.7%. But if you take a look, so all items is up 1.7%. And that's fine, right? But I know most people, they eat. They go to the grocery store, and that's up 3.6%. 3.6 for food. That's not helpful. Energy's up 2.4. So that means other stuff. Rent. I'm sure your rent went down last year. I'm sure of it, right? And all the other things you buy, a car insurance, I'm sure that went down, right? Everything goes down. No. A bunch of basket of goods went down, but the things that you think about, energy and food, those are up over 2%. Those affect people. And so I just think this is very interesting. Now on April 13, we're going to see March's CPI. And so the reason I think this is important is that if inflation goes up, your purchasing power goes down. If dollars I don't think you can hear me. Okay, good. Sorry about that. It looks like we had a disconnect in our studio. Sorry about that. So point I'm trying to make here is the next release, March 2021 CPI data, will be coming out April 13th. And what I worry about is if there's less money in your pocket to spend as an average consumer and prices continue to go up at these high rates, you're going to see a tightening of pressure on that middle class and lower class. You're going to see at Main Street a set of pressure. So jobs went up, people are going back to work, but the cost of living is going up in places where it hits the pocketbook the most. In the gas tank, or to heat your homes, run your air conditioner, and food. Keep your belly full. So we're going to keep track of that. We're going to be talking about this over time. So what's our government doing about it? Well, the Federal Reserve can print money, right? Open market transactions. They buy pieces of paper that say I owe you. I'll take the paper, stick it in the vault. By the way, I earn interest on this, so I'm loving it. Federal Reserve runs a big profit, right? I'm shoving IOUs, bonds, government bonds, corporate bonds, housing bonds, mortgage bonds, you name it. I'm shoveling them in. $7.688 trillion of assets on the books. Wow, am I making a profit if I'm the Fed? But I take in the IOUs and I pay out cash reserves, and that money sits on a balance sheet somewhere, and somebody is saying, I got to lend it out. I got all this money in my wallet. I just sold my bonds. What do I do with it? Hey, John, you want to borrow? Hey, can I earn some money? Hey, can I stick it in the stock market, maybe? Maybe I can invest this money. I got cash from the Fed. Loving it. I got 7.7 trillion cash from the Fed. It's a lot of cash, by the way. I don't care. I don't care who you are. Maybe $1 million isn't a lot. Maybe nowadays $1 trillion isn't a lot. But 7.7 trillion is a lot of money. So let's take a look. The first time this thing really jumped up to over $1 trillion was in 2008. You guys remember the housing crisis, right? And so we really inflated the system there because we had chronic deflation, right? People were worried that they'd borrowed too much money, so they deflated, they deleveraged, they paid back their debt, they stopped borrowing, which slowed down the velocity of money, which could have strangled us. And so the Fed did what they should do, right? Which is they started to pump money in the system. They got us up to 2.1 trillion and back to 1.9 and 2 and then blah, blah, blah. We're at 2. Then all of a sudden, I don't know what happened in 2012. There must have been some crisis in 2012. I just don't remember what it was. And we went from 2.8 to 4.4. All right, well, no good crisis goes to waste. Now we start to taper. We start to pay it down. I was so happy at the time. 2019, we came down nice. Look at that, 3.7, 3.8. We're doing a good job. Then all of a sudden, woo, it rose up. Before the pandemic, my guess is maybe in anticipation of the pandemic in the United States, they start priming the pump. Prime the pump. Then all of a sudden, 4.1 to 7.1. $3 trillion in like 3 months. I tweeted on this when it happened. I couldn't believe it. The money flow was just tremendous. But what's shocking to me now, and then they tapered a bit, right there, got to 6.9. And now from 6.9 in August, we're up. We're climbing. We're 7. Just crazy. 7.719. And now maybe we're down a little bit. So there's been a lot of money being pumped into the economy. And so that money is probably what's driving up the stock market. Probably. If I had to think about it, I would say, I'm going to try to zoom this out a little bit, that this is where we were at. So this is the big boom in the stock market. A couple $1 trillion doesn't hurt. Pump up the asset values. And what you're seeing now is you're seeing rises on low volume, and you're seeing, where'd it go? Uh-oh. Maybe the Fed didn't like that I was talking about that. Actually, I've never had that happen before. The Fed just completely took away my chart there. So, all right, no more talk about the Fed. We're sorry, by the way, if you're offended, but you keep pumping money into the business world, into the economy, you're going to see it show up. All right. So now let's talk about where that money went this week, right? So, and by the way, my final point was you saw it tapering down. They're starting to maybe slow down a little bit, maybe take some liquidity out of the market, and that's when you start to see the market rise on lower and lower volume. You see that lack of commitment, right? If I'm taking $50, $100 billion out of the market in a week, that's less money to sloshing around to stick in the stock market. So for the past week performance, by the way, thank you FinViz for the data. As always, we appreciate it. You do a great job here. Nope, I don't want to do it that way. I want to do it this way. All right, let's pop up here. So most of it's green. So in the past week, almost the entire market's green. I'm just amazed how that works. Let's just take a look at what's red, because there's not much. Okay, I've got Sherwin-Williams, paint company, Fox Corporation, Viacom, Disney, Charter, Comcast. I remember there was this hedge fund that blew up. Those were the companies probably that they were invested in. I don't know about Sherwin-Williams. Maybe that was a different issue, but I don't think that's a big high flyer. DaVita's down. Yeah, Sherwin-Williams. What's going on with Sherwin-Williams, by the way? I'm going to write that one down. Maybe that one's interesting to look at. Maybe the shorts are in attack mode. But it's just always interesting to me when I see this. There's a slight one. CarMax is down. What the heck's CarMax doing down? I love CarMax. You know, you bring your car in, they offer you to buy the car in an hour. And they make you a binding offer that's good for like a week. And then you go in to buy a car, and they got the no haggle pricing. So, I mean, maybe people aren't buying and selling used cars. Maybe everyone's getting a new car this week. I don't think so. I don't know why. So maybe the paint and the cars, not so good this week. I'm laughing because it's silly. And I'm joking with you. But what always surprises me is, Facebook up 7%. Come on, Google up 5, Twitter up 4, Netflix up 7, Amazon up 4, Tesla's up 3, Home Depot's up 4, Microsoft, Apple. I mean, you can't make this stuff up, right? These are the big liquid names. So one of the things that I will tell you is when the market is, people are getting nervous in the market, right? You want to put your money where you can get out. You don't want to have your money in a stock where it's thinly traded, because when times get a little rough and you're rushing to the exits, it's easier to rush to the exit in Microsoft. It's worth $1 trillion. You're gonna get hit. Somebody wants to own Microsoft or Google or Facebook or Amazon. But I got to tell you, my favorite stock, Summit Midstream. By the way, we increased our position in Summit. Call me a glutton for punishment. I don't know. But I love the stock. Personal now, because the Chicago Quantum Net Score no longer picks it. It's no longer in the efficient portfolio. Now it's just you hold it because you got a big tax gain and you want to wait for the distributions and you want to make a long-term play out of it. But so what happens is the market starts to teeter. You get a little pressure here, but I think it's from the preferreds, and I think it's from a secondary offering. I've been tweeting and I've been stock tweeting a lot about this because I've done a ton of research. I have a spreadsheet I'm about to show you. But market's coming down. Take a look. Right? Summit's coming down. And so when the market's thin, Summit's thin. Look at those volumes. It's like almost no volume. I want to say it was like 15,000 shares yesterday. It was like crazy. No volume. What is it? Oh, 40. Let's see. 44,000. Actually, it's more than I thought. 38, 34, 82, 52. Very little volume. So it's dropping on no volume. It's not a commitment play. It's not like it's crashing. It's just drifting lower, right? It's drifting under its own weight. And what I like is at $24, this thing starts to be a real steal. Like a cowbell steal. I got a fever. And the only thing that's going to cure it is more SMLP. And so I just want you to think about that, because I love SMLP and I think they're doing a great job. And now that the quarter's over, we're going to see how they did. When they release sometime in early May, we're going to find out, did they buy back some debt? Did they de-lever even more? How are they doing on the Double E pipeline build? The Permian Basin, Texas. Oh, I love it. There's going to be lots of drilling behind their area, their exclusive areas behind the pipeline. I think it's going to be great. But you have to have stomach of steel, because if the market were to drop 1,000 points, 20%, no one wants your SMLP. That's not even going to trade. If anything, you get a nickel for it, right? Everyone's going to be in and out of the Teslas and the Facebooks, the liquid stocks. And so I'm always surprised at the end of a market when the dogs and cats like SMLP start to move. And so my point is, what we're seeing is a flight to quality, a flight to liquidity, right? UPS. People are repositioning so that if the market does drop, they can be in the big names, P&G. And so, yeah, we're okay with that. I'm okay with that. I just understand that that's probably what's happening here. Hey, by the way, you heard it here first on Chicago Quantum. Now let's talk about the world markets. As we've heard, there's some challenges in Brazil right now. Banco Santander in Brazil. By the way, I love the guys in Santander, just generally globally. We have no business relationship with them, but good guys. And but there's some tough stuff going on in Brazil, but everywhere else, pretty much all green. Japan, financials had some exposure to that hedge fund we talked about that blew up, that was holding those media stocks. Yeah. Oh, look at that, Switzerland, Credit Suisse, also massive exposure to that one, down 19% for the week. I don't know, Telefonica, I don't know that was part of that, right? But so, very specific issues right here, okay? Takeda's down. I wonder what's going on with that. China still hasn't really recovered all the way, but these are names that are down that I don't know, and so I couldn't tell you anything about it. So, just in general, market's up, things look great, world is fine, with the exception of a hedge fund blew up. Thankfully, it wasn't a contagion. So now I want to talk about the trade deficit. First off, Jeff, what do I care about the trade deficit? You've never talked about the trade deficit before. Why do you care? Well, let me tell you why I care. Because the United States is sending its money away. It sells services, which is great. It sells more services than it buys. But it buys more products than it sells. And what we want to see is, it's okay if over time imports are more than exports, or exports are more than imports. But it shouldn't be forever. That should not be a forever statistic. You should have a balance of trade, in theory. Unless you really do have excellence in manufacturing, and you're selling to a country that does not have excellence in manufacturing. But I thought the U.S. had excellence in manufacturing. At least we used to. And so let's talk a little bit. So in January, imports 135 bill, imports 220 bill. So it's an 84.5 bill negative balance. How's that compare to last year? We were at 66. So what's interesting, last year was our exports were higher and our imports were lower. So I want you to write that down. The United States exports less now, but it imports more. A lot more. 18 billion more. Doesn't make me feel very good. It feels like we're going in the opposite direction here. And when I look at the trade deficit, it's gone from 66, 59, 65. Now you're in the 80s and you're not looking back. 80, 84, 80, 81, 86, 83, 85. So we are going in the wrong direction as a nation. We are buying more and we're exporting less. Not helpful. So when I look at the U.S. stock market, and these are many companies that make things, we're not doing so well. Unless, of course, these companies make things in other countries. And they're not really U.S. companies, they're just U.S. headquarters. That's fine if that's the case, because that's just global trade. But something to think about. I'm going to save this one. We're going to take a look at this in the future. I used to really look at this, foreign trade, I just think it's important to think about it, because It's one thing if we're hunkering down and we're saving nationally because of COVID, that's fine. But why are we importing more? It's a good question. Let's take a look at our U.S. federal budget deficit. Maybe there's something in there that's worth looking at. So I tweeted on this recently. Oh my, that's kind of a weird chart. Let's take a look at that chart. I'm not sure I understand that chart. That has a weird shape to it. So the last time the U.S. federal government had a surplus was in 2001. Those were good times. We actually spent less than we took in, and we started to pay down our debt, and we were healthy. Felt good. Personally, I don't want the U.S. government owing so much money that other countries owe our debt and start to be able to maybe dictate some terms. I don't like that. It doesn't feel good to me. Over time, they might say, you know what, U.S. government, you got to borrow money in our currency. I'm reading a book right now on financial crises based on money flows. I think it's from the Bureau of Foreign Relations. It is the driest academic book that I think I've ever read. And I'm still reading it. The reason is because when a country borrows too much money, sovereign as well as private money, as well as money in their stock markets, at some point, the people who are giving you the money, either the lenders or the investors, they want concessions. One of the concessions that they like is, well, why don't you borrow in my currency? Make it easy for me. We do this all the time, right? So you want to borrow from the U.S., you borrow in dollars. You pay us back in dollars. If your exchange rate collapses, you could just pay us 10 times as many of your currency switched over. And now you might as well just give us your entire economy. So I don't want to even think about the fact that the U.S. over time, if we borrow so much, could be asked to maybe borrow in someone else's currency. That's terrible. But let's take a look. So we look in the early 2000s, not a big deal. 2008, we had the Great Recession, they call it, right? I call it the housing recession. And sure, the deficit went to $1.5 trillion, and it really didn't come down until 2014. So it looks like you had 4 years of really bad deficits. Then it came down 2015, and then it started to climb from $0.5 trillion, and it actually wasn't quite at $1 trillion. And then the pandemic hits, and we're at $3 trillion. My understanding is that next year, 2021, which ends in September of this year, is also going to be very high. So once you start borrowing $3 trillion, I guess if you borrow it from people like me, U.S. citizens, we're fine. At some point, you're going to have to pay us more interest, right? That's when that 10-year goes up, because you borrow $3 trillion, I'm going to want more interest. Even I can't lend to a bad credit risk without, some compensation, right? So I might take 3, 4, 5% federal interest payments over time. That's why we're also nervous, right? At a 1.7% interest rate, this isn't such a bad thing. Could you just get a calculator out? What is $3 trillion at 10% interest rate annual? Forget the tax. We all got to pay tax on that money back to the government, but let's forget the tax for a minute. What's 10% interest, God help us, on $3 trillion? That's $300 billion. I don't know what the money we take in taxes, but $300 billion just to finance 2020's deficit. So let's say it's not going to be 10%. That's crazy. Let's go 5%. Now we're at $150 billion. So forever, until we pay that back, we've just put a lien on the U.S.'s tax bill for $150 billion. Let's take the year before. That's $1 trillion. What's 5% on $1 trillion? Another $50 billion. So now we got $150 billion plus $50 billion. I keep adding them up, right? Oh, look at that. It's going to come out to like $1 trillion of interest payments. How do you do that? How do you pay that? How do you pay $1 trillion of interest payments? Well, you don't. You refinance. You raise taxes. you say, I'm going to pay all this interest, but I'm going to tax you if you're a U.S. citizen. Now the problem is, right, why would I want to hold this debt if you're going to tax me more? They're talking about raising the tax rate to almost 40%. No wonder why. If you're going to pay me $1 trillion in interest at 5%, I want it back. I want it back. Give me 40% back. Give me 50% back. If you're rich, give me 80% back. I want it all back, okay? But the problem is that if the foreign people who are not subject to U.S. income taxes decide to buy these, they're going to get that money, and we're never going to see it again other than in maybe buying our businesses, buying our land, buying our institutions. That's fine. Buying our banks. Goldman Sachs, owned by the person who bought the debt, right? That's not helpful. I don't like that story. I think you got to bring deficits down. If the interest rate stays down, that's fine. But, high deficits means someone's got to pay. Or we got to print money. I could take you back to the consumer price index and the inflation number. And people are hurting. It's 3.6% more expensive than a year ago to buy food. So imagine in an economy, what are we, like a $20 trillion economy? Let's do a hypothetical here. What is the size of U.S. GDP by year? I always like to look at a government website so I can trust it better. Gross domestic product. All right, not bad. We're about 21. So let's take a look at the debt, right? And let's say we want to pay that 3 back, and we just write a check, print money, $3 trillion. Now next year I think it's going to be just as high. So let's make it $6 trillion. You know what? While we're at it, let's pay back $10 trillion. Okay? I'm going to write it. Where's my checkbook? Hang on. I got one. Actually, I do have one. Hang on. Big checks. Big checks for big business. These are corporate checks, right? There's a little ledger, right, that you write it down. So let's write it down. $10 trillion payable to the U.S. people. You know what happens? Inflation that year is now 50%. Because I just pumped $10 trillion into a $21 trillion economy. So let's round it up. 10.5, 21, 50% inflation that year. Now the funny part is nobody knows because the government isn't going to tell everyone. They just start printing money every day. Man, I'm just going to pay off $10 trillion over the next year. First off, that's a terrible thought that I'm having. I'm having heart palpitations because now you think, oh wow, price is going up. This is great. Housing prices went up. Stock prices went up. I'm making money hand over fist, right? The dollar weakens. Oh my God, gold went up. Everything's going up. I'm getting rich. But it's just inflation. It's an artificial increase. And then at some point people are going to be like, oh, wait. No. Everything's going up because the dollar's worth less. So one of the worries I have is you can either raise taxes and throttle economic activity to pay that debt down, or you get out your USA checkbook and you pay it off. I'm not sure how else you do it. You could cut spending. You could get rid of a lot of federal programs, but not when you owe interest payments up to $1 trillion at 5 or 6% interest rates. So let's be careful out there. Wow, I can't believe I just talked about that for 10 minutes. This feels like I'm back in my PhD program. So let's talk about how the U.S.'s deficit compares to other countries. So this is also on the same page. This is the dataLab.usaspending.gov. So this is a U.S. federal government. It's nonpartisan. You know what I mean? That kind of stuff. So the U.S. is a $779 billion deficit, 4% of GDP. France is at 3%. UK is at 2%. Australia is at 1%. Canada is at 1%. Germany is at 1%. Korea is at 2%. let's add a country. Okay, what country do you want to add? Let's do Brazil. Let's add Brazil. They're normally a big winner, 7%. So we're not as bad as Brazil. I love Brazil. I apologize for pointing you guys out like this. Let's look at Greece. Where are we compared to Greece? Wait a minute, get in here. Yeah, let's take off Germany. Of course, we know. Greece is at 1%, so Greece is doing better than we are. God, that's been a long time in the making. Let's see. How are we doing compared to Mozambique? No, they're not even in there. How about Mexico? How are we doing compared to Mexico? 2% budget deficit. Mexico's at 2%. We're at 7%. All right, let's take a look. Wait a minute. Venezuela. How are we compared to... Venezuela's not on the chart. How are we compared to Venezuela? That'd be great to see. How about Rwanda? How are we compared to Rwanda? Oh, 3%. So, guys, I got to tell you, we're worse than every country I know except Brazil. Or the data's missing. So, come on, federal government. Stop it. Figure out a way to support the economy, to support productivity in America without just spending money you don't have. So let's look at labor wages, right? Everyone likes to look at wages, right? Because this puts money in people's pockets. So this is interesting. Make sure you can see it. By the way, this is the Bureau of Labor Statistics. I think this is very important. So again, why are we doing all this? Because we're trying to look at Main Street economy and see if it supports a rising stock market. Compensation costs were up 0.7 from September to December of last year, and up 2.5% over the year ending December 2020. So over the year, total compensation rose 2.5%. Raises and salaries rose 2.6, benefits 2.3. So people's wages and salaries over the 3-month period were up 2.6%. That's not bad. In fact, if you take a look at it, private industry, you averaged $25.48 an hour worked. Your benefits were $10.74. People work for benefits, so $25.50 an hour. And so if you work for the government, those numbers have a slightly different mix. So I just want you to think about it. So the average American made $25.50 an hour. It's up 2.5%. Now we know inflation was up 1.7, so there was still a small positive gain. But this is not like high flying. This is just a little bit of increase in wages. So we're not seeing inflation yet. And so we talked about rig count, we talked about the bonds, talked about the size of the GDP. So let's come back to health of the markets. That's really where this whole thing started. And I'm just going to pull back to the S&P 500. So the S&P 500 reflects large companies in the U.S., and it's not their results right now, but it's the results that all of the collective knowledge globally thinks that these companies are going to do for the next year, for the next 3 years, right? And they still see the market going up. They still see a healthy market. They still see good business, right? Real estate, housing prices are up because of a limit in supply. You got a slightly positive earnings trajectory for the American people. Look at that. March jobs growth, jobs report is up. So there's more jobs. There's slightly positive earnings power. And in general, things are looking a little better. Money remains loose. So more money flooding into the market. And if anything, with government deficits piling up, you could see even looser money in the future. So that's still a positive for the S&P. And so I would say from a perspective of the markets, it's cautious, but there's some logic to the rising rates, rising prices. So now I'm going to switch gears and talk about business. how we doing as a business? How we doing? Well, first thing I can tell you is bought some server memory. We're maxing out our server. It's a little bit of an old server, so it's not that expensive, but we bought another 32 gig. We're going to take our workstation, which is a 420, HP 420, maxing it up. So the problem is it's still a little slow. So now that we're analyzing 3,500 stocks at a time, we've added a number of analyses. We do beta checking. We do beta dividend bias removal. We're doing all kinds of verification, validation on the data. And we're running our models deeper. And I got to tell you, the server takes a long time. So we're going to speed that thing up by buying a brand new server. And so I've got a line on some high-end HP gear, the newest, most powerful HP workstation. And we're going to be getting that. Maybe not quite right away, but every morning I'm trying to get one from HP. So we've got an in to get a good discount. I never pay full price. So it's good. The other thing I wanted to show you, and it's hard because I was so proud of our videos at first. We had thousands of views. Thousands. And so it's going to be hard to see these numbers. Let me move this over here, but let me just point it out. So we reached a peak. Our week 6 had 6,300 views. I thought we were the most popular people in town, right? We were at almost 5,000 views for week 8. And then you see the views drop to about 15 to 28 views. And so my guess is this week's talk will have another maybe 15, maybe 30 views. And why is that? Well, we were paying for advertising. We were paying to put our video in front of economics-minded, stock market-minded people. And I got to tell you, they clicked on the video, they watched it. They watched it for a half hour. It was great. They went and they clicked on the website. But you had to pay for those clicks. So I decided after week 8 to no longer pay for advertising. And let's see what happened. And so now the number of views is down, and I just wanted to share maybe why that would be. And so it didn't even cost that much. I think I was paying a couple $100 a week to get that view up. And then actually our head of HR said, Jeff, so is it an ego thing, or are you really making money when you advertise? And what I realized was it was an ego thing. And so we don't advertise. We may advertise again in the future, but for people who want to watch, they know where to find us. And there it is. Well, I have a list, so let me make sure I'm covering all the items. Yeah, I can bring this up. It's nice. It's a small set of things here just to talk about. Zoom on in, 48 point. All right. So one thing is, because we have primarily one large paying customer who keeps us going, we are picking winners and losers every week. So we pick the most efficient portfolios and the most inefficient portfolios. And we've gotten it down to a science because we've tweaked the model, we've tweaked the way that we run it and the way that we produce our results to make it actionable for a high net worth investor. And so now, if we're picking losers, if we're picking stocks that have just a tremendous amount of risk and volatility in their stock market returns without the associated beta, then you're basically talking about a stock that's thrashing in the water. It's not moving anywhere. It's like treading water. It's up, it's down, it's up, it's down, but at the end of the day, it's not moving. It's not going up. There's no trend. There's just movement. And that usually means there's speculation. There's meme stocks. There's just a lot of noise. And so we can find stocks with a lot of noise. Now what happens, I'm going to tell you a secret. When you find stocks with a lot of noise, you don't invest in them together, because the power of diversification in a bad portfolio is massive. It's great. If you take 10 dogs and you hold them together, it's a cat. It's not bad. You take one dog at a time and you short it and you manage that position, you have a great potential to make a ton of money. And so when we pick our losers, we've changed the way we think about it. We've changed the way we run our model because of the way you might act upon a bad stock, right? It's working. And I got to tell you, we've been picking new bad stocks, and all of a sudden I look and NASDAQ is halting trading due to massive volatility. There's one stock, ACY. Love the stock. We picked it like a week and a half, 2 weeks ago. And after we picked it, I dug in, and they owe Drake Asset Management more money than the company's worth, and it was due at the end of March. So I remember tweeting. I didn't buy any of it or sell any of it. I just tweeted because I wanted people to follow the model, right? I said, yeah, the thing's going to be bankrupt by the end of the month. They owe like $80 million to Drake, and they got like, 13 airplanes. And someone's like, no, you're wrong. No way, man. No way. So the stock went from $13 to like $3.50. So if you would have bet against it, you would have made a ton of money. Then all of a sudden, I look yesterday. I swear it's crazy. It's crazy out there. It's like the old pools from 1929. All of a sudden, the stock's back to 13. They declared bankruptcy. They're in bankruptcy. They're trying to negotiate. They're looking for buyers. They think the whole company's going to go to Drake. And Drake doesn't own the stock. It owns the debt. The stockholders are going to get probably zero. Maybe a penny. Maybe a nickel. I don't know. But not $13. It's because they're squeezing the shorts. I love it. How do you squeeze the shorts in a bankrupt company? I don't know. But the good news is our model's picking those stocks. It's picking the weird dogs, overpriced, undervalued meme stocks that are going to get crushed if you're patient. The efficient stocks are changing. This is the other thing I wanted to just share with you guys. I love this. It's so fascinating. We see new industries represented. We see completely new stocks being picked. And I was trying to figure out why that is. It's not because I got my vaccine for COVID. It's not. It's because that period of the market where the market hit its low post-COVID is gone. Now, when you look at a month's worth of trades, you're more in that upward trend. You've lost the downward trend. So now the question is, how do stocks perform in an upward market? Upward to flattening market. It's more normal, right? And if the market does over time flatten out, you're going to see stocks that do well in a flatter market. So the stock picks are starting to represent where we are now. Second is we bought a beautiful iMac Pro. I've had some comments that the video quality is better. Thank you, by the way. We like it. I would say it's not like a hurricane came through and made everything so much faster, but it did make it a little faster. We also bought a nice HP curved monitor, which is over there, which is what I'm looking at sometimes because I have the side pages there. And we are looking at buying an HP workstation, which will have truly superpowers compared to the server we have now. And we max out the memory, so that's exciting. I want to talk a little bit about our data feeds, because for those who follow us on a more technical basis, we're struggling here, right? So we validate our data, and it takes us much longer than it should in order to get it just right. And the process of coding and recoding it keeps teaching me more things. In fact, I woke up this morning, I went to bed late last night, thinking about the changes I have to make today in the code. But all that teaching is making me a better Python coder, but it's not making the answer. It's not going away. The problem's not going away. And so the result is that you pay your $750, and that should take 3 hours. And the time should go into the analysis of the results and the report writing. But lately it's been taking up to 10 hours. And so we continue to evaluate new market data providers. If any of you know of good market data providers who could provide equity data at a fair price for commercial use, we'd be happy to talk to you. And then we have temporarily stopped using the D-Wave Systems Quantum Annealer for our largest stock market exchange runs, the 3,500 stock runs. And the reason is simple. As we've changed the way we tweak our model and we run, we're running more than the number of stocks that the Advantage can run. And so, and when we can get it right to the max, the problem is it takes too long. And we're not seeing a lot of value out of it. And so for right now, we've discontinued to use D-Wave for the largest runs. The $150 run, we still use D-Wave. Still can give us good results if we have fewer than 64 stocks. And so we do need to invest. We do need to maybe bring on some researchers and really take the time to figure out how we get the D-Wave to produce economic value for us again. Because for right now, it's almost like we got too big to do it. And then finally, but not least, we are proud to be media partners for Quantum Tech. So Quantum Tech is a business-oriented quantum computing conference that'll be held virtually this month. We always attended it in person. It's in mid-April. We hope that you will attend. Registration is free. And we will tweet and post about the conference. We'll attend virtual sessions. And we'll be there. And I'm actually looking to see if I have... There it is. Splash it on up here. So Quantum Tech was one of the first events that supported Chicago Quantum, and we will always support Quantum Tech, as well as some of the others, Inside Quantum Technology, Swiss Quantum Hub, Q2B, but Quantum Tech was the first. And so it's good. It's a good place. You can sponsor them, by the way, get your name out there if you got big money. You can view the speakers. You can register for free. And so let's see who's speaking this year. See who I know. Oh, Kamchana from Merck. I like that guy. He's quite bright, and he works in the space. Doug Fink, we love, managing editor of the Quantum Computing Report. He was the first quantum computing company to make a profit. Yanni Gavros from QCware. He's been in there since the beginning. Michael Hayduck. Yes, sir. Good guy. Jennifer Houston from D-Wave, right? Head of marketing. Mark Jackson, we know from Cambridge Quantum Consulting. Cambridge Quantum Computing, I should say. Jay Lowell, we know from Boeing. Good on the technical side. Celia Mertzbacher from QEDC. She's no longer associate director. Got to update the site. She's the new director of the QEDC. And very excited about that. And there's a bunch of people that we know. It's a good crowd. You're going to learn a lot. If you could attend all those sessions, you'd have a really good understanding of where we are. Oh, Matthew Versaghi from United Health Group. Carl Williams, Dr. Williams, from NIST. I know him since the beginning. And so these are people that are kind of right in the center, right in the mix of the business. And so I would say keep... oh my God, and the advisory board is a who's who of people that we know, people that we've worked with as we started up our firm. And, of course, you know, Dr. Bob Suter from IBM. Very impressive. Wrote a book. Actually, lots of people have written books, but he wrote a pretty good book. And so it's a good conference. See if you can attend. See if you can catch some of the important sessions. We'll be tweeting out some of the stuff, and it's good. So I want to thank you for listening. It's Friday, April 2nd. This is Jeffrey Cohen. No commercial this week. Just do a great job out there. If you're in the quantum space, focus, try to drive improvement, drive change. If you're in the business space, find clients and help them. It doesn't matter if it's quantum or not. Just help them solve problems, right? Sometimes it's quantum, sometimes it's just big data analytics. And if you're in the markets, good luck out there. And again, I want to thank you. Just a quick shout out, John Alcock from Tencent. We also have a budding friendship with John. And Joseph Brose, who was the previous director of QEDC, is now VP at IBM. So nice landing, Mr. Brose. Okay, take care, everyone. Bye-bye now.